This is John Martinka, and welcome to the Getting the Deal Done podcast. Today, my special guest is Trever Acers, and he is with Objective Investment Banking Valuation. He's in San Diego. The company also has offices in LA and Dallas. There's about 20 people in the organization. They concentrate on the investment banking side, sell side representation of deals 25 to 250 million, and they have some industry groups they target, which Trever can get into. Welcome, Trever.
Yeah, thanks, John. I'm excited to be here.
Yeah. Why don't we start by you just talking a little bit about how Objective came about and the type of industries you target and just the overview.
Sure. Yeah, the company was founded about 15 years ago. I started my career in strategy consulting and eventually went into private equity. What I saw was that a lot of business owners weren't getting great advice. They were ending up making bad decisions that they were very disappointed about. And as I looked at that, it seemed like there was some pretty simple changes that needed to be made in terms of how they were guided, what kind of guidance, how they frame up their decisions that could lead to some significantly different outcomes. So that, in addition to sort of the strategy and transaction experience, that was the ethos for the company.
Okay.
And so now we're our sell side group basically is just represents sellers. It's all we do all day. In our 6 different industry groups. So we cover technology, manufacturing, consumer products, pharma services, business services, and healthcare services. And our goal is really to combine the transactional excellence, which is sort of a checkbox. It's a requirement. You have to know the industry and you have to know how to do a deal exceptionally well. I think the things that we designed the business to be different in is that we are very, very strategy driven. We tailor our sell side strategy every single time to our clients' objectives. And then the other piece of it is we've really designed the entire process and how we work specifically to companies of, call it, 25 to 250 million, which means you're really looking at a much bigger set of objectives because our clients are typically individuals and not, faceless shareholders.
Okay. Well, I understand the part about research and knowing it. We have a client now that's in a very, very fragmented industry. We have a nice offer on the table, and in research, it says there's maybe a handful or so of companies that have the wherewithal to buy him, being one of the largest with all the small fragmented. And you have to know your market like that, so it's very important.
Yeah, I tell you, it's one of the things that we do is so our industry folks spend a lot of time with the active buyers in that space. So they tend to know all the buyers, which is great. But guess what? Our clients have LinkedIn and they have Google. They can find those buyers as well. I think the differentiation in the value prop that's occurred recently, or the transition that's occurred recently for advisors, is that value proposition is less about sort of I know who your buyers are, and more about I know how your buyers think. So we spend a lot of time with these buyers. And the other thing we do is we believe that advisors, one of the worst things they can do to their clients is come in with an ego that they somehow know all the answers. And so we almost always do pre-sale market intelligence where we go back to the buyer with a no names profile and say, we're looking at a range of options. Tell us about some of your feedback, because you can know that space so well, but big companies' priorities change regularly. And so getting a real good heartbeat on exactly where they are allows us to hone that story to figure out exactly how we maximize value for our client. So I found it like it's been incredibly impactful to have that kind of industry insight.
Yeah. Okay. Well, let's talk about trends. You're working with successful businesses. They're going to sell for at least 25 million. What's going on?
Yeah, I mean, to give you some context, we spend a lot of time at that 25 to like 75 space. There's just and the reason is there's just very few world-class advisors in that value segment. And because of that, there's been this mass, the biggest trend that's occurred is the fact that M&A has become a normalized business activity. If you compare M&A activity 15 years ago to today, it's just radically different. And business owners, we live this. And this is the test is we are, well, 15 years ago, every rare once in a while, someone would talk to us about buying our business. Today, we're getting emails, texts, letters. Business owners are constantly being solicited by buyers. And so it's changed the intelligence that as business owners we need to have. And here's this risk, the backdrop, if you will, is that when you look at these business owners and they're surveyed 2 years after the sale, the trend is, boy, we have a lot more transactions going on. The data says that when surveyed 2 years after their deal, greater than 80% of them come back saying that they felt like they failed in their transaction in at least one way. And when we looked at the data, a lot of the data, I didn't get enough money, but a lot more of it is around qualitative elements of they fired all my people, they didn't serve my clients well, they moved my operations to whatever it was that person held to be important. Those things didn't come to fruition, and it's concerning. The trend is that we have these heroes of our economic society and these business owners, having this massive self-reported failure rate. And that's the trend. And it's odd as we look at that trend, it ends up being pretty clear of what the root cause is. And that's the nice part about it. And the root cause is they did not know what they wanted when they went into the deal. Had they known, had they had very clearly understood objectives, so qualitative objectives and quantitative objectives, going into that process, they would have designed a process and picked the transaction or the option that best fit their objectives and could have avoided this, all these failures.
Okay. All right. Well, that makes sense. A lot of times they don't think of that, and they need someone to help them through that. We had a deal recently where the client just said, I have reached my ceiling on managing people. I love the business. I can sell. I can do client strategy. I don't want to manage anymore. He knew that. That was the goal.
Yeah, I think it's really neat when a business owner has a good idea of what they want. It's also rare. I ask business owners to have this understanding of exactly what they want. It is really tough. There's no question about it. I'm a big believer in the opportunity for wealth managers to come in and help from their advisor perspective and be able to help that entrepreneur intimately understand what's the impact of the money and what is the impact of another X million. What does that do to my life, my family, my objectives, my legacy? We were on a call today, and it was so valuable as the advisor is working in collaboration, right, with my client, trying to help them understand what is that number, what's that number you need, and how much risk should you take, or maybe you should give it to your cousin or your uncle or whatever that objective may be. But it's really helping ferreting that out. That helps significantly improve the probability that they're going to be happy. And so we have this litmus test that we've developed. We call it 2 a.m. number. So the 2 a.m. test. And so the goal is that 2 a.m., 2 years after the deal, they get up, they look themselves in the mirror, right? It's the most honest time we have with ourselves. And we say, all I want them to say is, that was a good decision. That's the hardest thing to do in M&A. 2 years after the deal, that was a good decision. Not fireworks, oh my golly, unbelievable, just really good decision making.
Yeah, interesting. Very, very good. Very good test. Yeah. So do you, when you get introduced to an owner, is it taking them to market pretty quick? Do you work with them on increasing the value and therefore the price?
Yeah, I think there's a number of steps. And the first thing is really understanding those objectives, hence the name of the company. We called it objective because we believe that success or failure is defined uniquely by that client's objectives, not what society says is the right thing. So really at first, it's helping them understand what they're trying to achieve, and then tailoring a process and a strategy that maximizes that outcome. But ultimately, advisors are paid because they increase price. It's price, probability, and then all the heavy lifting to get the deal done. Those are the reasons why they pay you. And there are some things that you can do to increase price. And most everybody in our industry runs what they'll call a two-step competitive sale process. And that's kind of the assumption. The perception there is that a competitive process, or even the threat of a competitive process, can increase value, right? You and I have all been in a bidding situation where we can viscerally understand that. There's opportunities though that are right in front of business owners that they're often missing. And the biggest one is that they fall through that they follow this default path that acquirers ask them to do. So the acquirer says, "Hey, why don't you send me your financials and let's figure out how much this business is worth." And they send them the financials. And so that conversation that they're having with the buyer, that effectively is not only about, do I want to buy you, but a lot of the subcontext is, how much do I have to pay for this? It's all focused on a critique of our historical financials. So you can imagine anytime you start a conversation and all it is a series of criticisms, legitimate or not, but a series of criticisms on something, it's not going to lead to the best price. And so what ends up happening is a default price comes out. So if you think about that price range, the buyer, if they're experienced, most buyers that are out there today, active or professional buyers, this is what they do. They're going to be making an offer in the lower half of the value range, because that's logically what they should do. The challenge is that business owners then are just trying to fight with, hey, I think you should pay me more, which we call bone-on-bone negotiation. That negotiation style has a very limited success. So you can't traditionally move up the purchase price much with that. The piece they're missing is really understanding why the buyer is there in the first place, right? The buyer is there in the first place because they want to get something out of it. So our recommendation, and we run this process very, very consistently and through most of our processes, is to pause at some part in the process once we've identified and qualified down to a small group of acquirers, and stop there and lean in. And that lean in is basically a collaborative approach of, hey, we've given you the historical financials. Let's spend a little bit of time better understanding how much money you, Mr. Buyer, are going to make in the next 3 to 5 years. And so we start collaboratively identifying what are the synergies. Let's identify them, let's characterize them. Let's quantify them. How much is that? Okay, boy, if you can sell your products to my customers, how much revenue do we think we're going to make? How much gross profit? What's that incremental profit contribution coming from that? And we look at that synergy A, we quantify synergy B and synergy C. We add those up, and now you can see, hey, what we're providing is significantly bigger than the EBITDA or what they're shown on our financials. The last thing we do is validate. We help them and actually say, these assumptions that you say about synergy A and synergy B, let's get really confident about that. Because what I want that buyer to go back and do is say, hey, to their boss and say, look, I know we're being asked to pay a premium on this deal, but here's why it makes so much logical sense for me to do, because I have a very strong belief that in the next 12 to 18 months, we're going to achieve that. I can give you a recent example. We saw a deal the company was at $5 million of earnings, of EBITDA, and they were trading at, call it 7 times earnings. So a $35 million transaction. As we looked into the synergies that were not the pie in the sky someday synergies, but these near term, next 12, 18, 24 months, very foreseeable synergies, we found basically about $4 million of incremental profit, them selling their products to our customers, us selling our products to their customers, the classic, what we call post-acquisition economics. But $4 million of synergies. And then from that, we saw that, boy, that means that in the next 12 to 18 months, instead of just getting my $5 million of earnings, you're actually going to get $9 million of earnings. And then if you're trading, if that buyer happened to be trading for, call it 10 times earnings, that means that they're going to get $90 million of shareholder value. So if I'm pushing you to go from, call it a $35 million valuation to a $45 million valuation, and you say, oh my golly, that's so far out of the market range. It might be, but go back to your board of directors now, or whatever decision-making group you may have, and share with them, I'm going to get $90 million of value with a very high degree of confidence. And yeah, I have to pay $45 million for that. So that methodology, we call it reframing the conversation. That's the conversation that business owners are unfortunately not having with their buyers. I think it's one of the biggest missed opportunities when selling your business.
Yeah. And sometimes the buyers know it when they're coming in. And we've got a client now, and the buyer, large organization, knows that they have a sales channel the large organization doesn't. And that's the attractiveness.
Yeah, it's interesting. The buyers, they want this. They really want this insight. They sometimes feel threatened at first, and they'll say something, well, Trevor, that's my money. Like, yes, I'm not trying to tell you that you need to pay me $90 million. What I'm trying to do is to help you understand, Mr. Buyer, that you're making a really good decision in buying us, and exactly how much you're going to get and what's the probability of achieving all of those synergies. To me, it's a good partner. It's a really good partner thing to do. And it positions that buyer to feel really comfortable about paying that premium.
So, Trevor, how often in something like that, to get that increased price, is an earnout involved in your world?
Earnouts have a terrible reputation, right? Because
Lawyers love them.
Because most earnouts are horribly misdesigned. They're not thought about, right? They're an afterthought. They're a cherry on top. Earnouts to me are a bridge. And this bridge basically says something like, I believe X, you believe Y. So that business owner says, well, I think next year we're going to keep growing at 33%. Buyer says, boy, you've only grown 10% a year for the last 10 years.
Yeah.
There's a gap. So it's a great bridge. In the post-acquisition, in the situation where we're identifying synergies, the need for a earnout is really a function of how believable are the assumptions. If together we look at the assumptions and there are a lot of unknowns, then for us to capture that additional value, we're going to need an earnout mechanism, sharing that risk of the unknown. One of the reasons why we go through these 3 steps of identification, characterization, and then validation is because we want that buyer to actually have a stronger and stronger degree of confidence so that we don't end up with a huge earnout piece. Typically, for most clients, earnouts are things we'd like to avoid, but sometimes they're appropriate. When there is true risk to be shared, earnouts can well-structured, well-thought-through earnouts can be really good tools.
Okay. So you mentioned before, business owners are getting bombarded with buyer solicitations, which you're right, it's just taken off. There are no secrets with the internet. And give us your impression on that and what it does for owners and what they should do, etc.
Yeah, it's it feels like a great problem to have, right? And that here's this call. I lead our technology practice now, and our client gets a call from Microsoft and says, "Wow, this is so amazing! Microsoft just called and wants to buy me," and that's what a compliment, right? We feel that as business owners, we built something. We feel this great sense of pride in getting that. The challenge is that we're getting a lot of that now. A lot of people are reaching out, and they could be legitimate companies like Microsoft or the leaders in whatever space you are. They might be private equity firms, or they might be people that have no capability to actually get your transaction. I still get letters today. I want to buy your company. I have to remind them, I'm an investment bank, right?
Yeah.
So there's a lot of noise, a lot of people trying to get your attention. And so we were working this, we came up with a methodology in a point of view on this. And it started, we were working with a very large investor, a very large private equity investor. And their concern was their CEOs were getting a lot of these types of calls. And their fear was twofold. One, they didn't want to miss out on that lottery ticket, right? That one buyer who calls up, you're 3 years before you think you're going to sell, and they're going to give you that price today. You don't want to miss that. And then the second thing is they recognize the cost of distraction. So the cost of distraction is something like, boy, you get this call from Microsoft and you end up having this conversation with them for 5 months. Your management team gets involved and it goes nowhere. And unfortunately, what we could have figured out is that you actually could have figured out, had you known everything, you would have figured out almost day 2 in that conversation that it wasn't going to get there and saved yourself 5 months. And that it doesn't sound like much. You'd say, if you looked at it without thinking about too much, you'd say, wow, great conversation. Sounds like money well spent. However, 2 things there. A, if you can figure out that there's merit to that conversation up front, more importantly, if you can figure out there's not merit, they're not going to be able to get there at this point in time. You could have not gone through that. And here's an idea of this distraction is, if your management team is shooting to hit, call it 4 million of earnings this year, and instead, because of this conversation, you end up at 3.5 million of earnings, because M&A is incredibly distracting to management teams.
Right.
So we're a half, you'd say, well, we missed by a $500,000 of EBITDA. Okay, instead of getting 4, we hit 3.5. Well, that $500,000, let's say you're trading at 7 times, that means that's $3.5 million of shareholder value that we just destroyed by deciding that we wanted to have a conversation with this buyer who just called, versus keeping our heads focused. And that's what they were asking us to look at. And so we came up with this concept of, boy, we really need to be able to have a methodology that says, is there merit to this conversation? And should I continue to pursue it? And so we came up with this idea of what we call aggressive disqualification, and a mechanism to basically have confidence in saying, hey, are you my buyer? No, you're not. So I'm not going to pursue this thing, even though it's shiny and interesting and exciting. Very low probability of me achieving my objectives. So I'm better off focusing on the business.
And so would they have hired you at that point?
Yeah, we often get called when that acquirer is that's of any interest, is soliciting them. And so it's a change, because investment bankers historically got only engaged when someone wanted to go run a market process. I'm ready to retire. I want you to go talk to the 250 buyers around the world who are going to be interested and run a competitive process. I'd say greater than 50% of our work now is a situation where someone gets called by a buyer. And that's that one buyer. And the question is, okay, do we want to do nothing? Do we want to just keep heads down? Do we want to just talk to that one buyer and see if we can negotiate a market premium price? Do we want to talk to a couple buyers, or do we want to run a full market process? And the first thing we do is help them understand what their objectives are and what we want to do. And when we understand what their objectives are, we can then go to that one buyer and even figure out, is this the time? Because a lot of times a business is not at that place where they're thinking about selling. They were executing growth plans. And so we might go back to that buyer and say something, after talking to our client, we may go back to that buyer and say something like, our client is executing a 3-year growth plan, but they're willing to preempt that process because there's such a strong fit here, and it's obvious, and we all get excited about that. But in order to preempt that price, our clients are probably not going to be willing to sell for less than X. And that number typically is not correlated with the financial metrics of the existing historical performance. It's usually a function of where we're going to be in 3 years. And what I'm trying to do by that is I'm trying to do two things. One is I'm trying to get them to go to way as a buyer. Because if I know my shareholder needs $40 million or $70 million to sell the company, if I share something like that up front and the buyer says, whoa, based on your size, we're not even close. Great, go away before you distract my client. I keep my client focused on the growth at that point. The other thing I'm doing is if they're even remotely interested in paying that price, you're actually giving them a buy now price is effectively what you're doing. If they are, one of the things I'm doing is I'm creating a floor and not a ceiling. So the ceiling is if I offer you an apple and say I want $2 for it and you're negotiating with me, you're never going to pay me more than $2. If I tell you that the opening price might be somewhere around $2, but by the way, there's other people that have interest, I've created a floor as opposed to a ceiling. And so that's a critical piece of that negotiation strategy. But really, again, I'm being a good partner in the relationship. I'm saying, let's not go waste our mutual time going to pursue this unless you're willing to pay $70 million today. Because otherwise, my client is better served focusing on our 3-year growth plan. And you're honestly, it's a weird word for an investment banker to say, but you're being a loving partner to that person.
Okay. Well, then, so the company, they're not wanting to sell now. They're saying, wait, we want to sell. And, the typical thing is, 3 to 5 years, buyers, banks, investors ask for 3 to 5 years of financial stuff. So they say, I'm going to sell in 3 years or so. What do you do to help them make it more attractive to potential buyers?
Yeah. There's two pieces that are critical here. When they share something like that, the first thing we want to do is really clarify or create at least an initial set of understanding of their objectives, right? Hey, boy, if we were to sell, and what I want them to is, if it's closely held, I want them to think in after-tax cash terms. If I'm going to sell my business, I want at least X in after-tax cash, if that's how they're thinking about it. And then I want them to think about those qualitative things. What impact do I want to have on my employees? What does the upside look like versus me walking away with cash today? Which one is more attractive, or what that mix might look like? What do I want for my customers or my legacy? I want them to really flush that out so we understand what we're shooting for. Once we understand what we're shooting for, now we can sort of transition into, let's look at the business and figure out how we can help you accelerate the growth of those things. And there's a number of, it tends to be industry centric of how you help somebody. Another reason why industry knowledge is so helpful. But for example, I spend a lot of time with software companies, and in the SaaS space, if we can move maintenance revenue and start pulling apart with the services they provide in their maintenance and allocating those services into what we provide in our subscription, charge a little bit more on our subscription for that. What we're seeing is that, I get maybe 4 to 6 times ARR or revenue for subscription revenue in terms of valuation, and I'm getting 1 times on maintenance. So you can start seeing, boy, I'm getting a 4-for-1 or a 6-for-1 exchange as I move dollars into this subscription revenue. So that's an example, an industry-centric example of how you're trying to help them create value. Other times we see certain lines of business are more attractive than others. Across industries, often a subscription or reoccurring revenue stream is more attractive than, call it, project revenue. So you're able to really look at that company and say, what do buyers want? And what does that tell us? And how do we put ourselves, if we have 3 years, in a place that are most attractive about buyers? The common knowledge or the common guidance that we would ask, if we asked 100 advisors, they would tell us a lot of the same things, which is, hey, we need to make sure that our accounting is clean, so that when we go through that process, we don't get dinged for having poor accounting. Totally true. It's a great thing we need to do, right? We need to have our legal perception picked up. We are probably really well served by having brought in a team of advisors in advance, just the same way we would have a management team in a company in advance of our sale, so they can do some pre-sale planning, so they can do all these things that sort of help us through that. That's the guidance. And it's more and more, because M&A is becoming so normal, it's pretty common for us to work with a business owner 3 years before the sale.
Yeah.
helping them walk through this. We meet with them quarterly. We call it a cultivation process where we meet with them quarterly and really try to identify those things. On the other hand, a lot of our calls are, I just got called by Microsoft today. What do I do? That's pretty common as well. I got an offer. What do I do now? And the goal is, boy, let's jump in there and help you make a really good decision. And do we maximize price to increase that price, increase that probability?
I got one more quick question, and then you can share any other thoughts you have. In your deals, do you run into much where there's an owner dependency?
Yeah, it's a pretty common element, and that owner dependency is this concept of, boy, the owner represents has the key relationships with 50% of the customers. That's a problem. That's a problem because as a buyer and as a business owner, we often, when we're running the business, we don't see that as an issue, right? We see ourselves as rainmakers. We see ourselves as heroes. The buyer sits there and says, I see that as risk, right? You say maybe you want to stay with the company, but what if you get hit by a bus tomorrow? And then, by the way, as a buyer, I need you to stay. I need the business owner to stay in the business for X number of years so I can transition those relationships. So it's a very common, very detrimental aspect. And so some of the things we're often looking for is help me, business owner, tell the story about how this business is no longer going forward dependent on you. And it's an interesting element because as business owners, I don't want to ask them to hurt their ego. I'm not asking them to say you were never relevant. What I'm asking them to share is, hey, the business wouldn't be in the place it was without me, but I have built it in a way that it doesn't depend on me going forward. But yeah, very, very common issue, unfortunately, that does come up.
Yeah, it's in my world of the deals, under your size, it's very common. And I was at an ACG meeting recently, and they did a case study, and an owner on a $70 million deal, he basically said, my partner and I realized during due diligence how important we were to the day-to-day of the business. And
Yeah.
it's not the way it should be on that size deal.
Yeah, and there's that buyer has to pay less, or they have to put in larger amounts of earnouts, like you mentioned earlier, where they're trying to use things to bridge that gap. So there's not only a price impact, but there's a structural impact that occurs, and it's at some level avoidable, right? It's, boy, how do I transition these relationships to other people? How do I systematize my sales team so these relationships aren't single point with me? They're a relationship is spread across that team.
Okay. Any final thoughts, Trevor?
Yeah, I think that I think one of the things we're going to see going forward, we talked about the themes, the trends in the past and the normalization of M&A. One of the things we're going to see going forward is business owners getting smarter and smarter about M&A. Right. I feel like there's these disciplines that we're as business owners required to get smart at, and they kind of get thrown at us. We were happy with the things we knew, and then suddenly they need us to get smart about something else. COVID being a wonderful example of that. I think in the future, we're going to see business owners getting smarter and smarter about M&A. And it's exciting to me because I think there's a ton of opportunity for improvement, be it the way we frame, change the frame away from a critique of our historical financials towards the synergies and how much that buyer is gonna make in the next 3 to 5 years, or getting smarter about how we do data analysis to be able to show the retention rate of our customers in a number of different ways. And then avoiding, I think the thing that really gets to me is it's avoiding the nightmare outcomes, right? It's avoiding that scenario where 2 years later they look themselves in the mirror at 2 a.m. and say, I feel horrible about the fact that my key employees got fired, or that my customers now call me and tell me about how terrible my company is now. These are the things, that's what excites me the most, is business owners getting better and better about making really good decisions so that 2 a.m. they look back and they say, you know what, I'm really proud of that decision.
No, excellent advice. Trever Acers, Objective Investment Bank and Valuation. What's the best way for people to get hold of your firm?
Yeah, our website is great. Tells hopefully has a lot of value there in terms of what's going on in the industries that we cover. That's objective ibv.com. That's as I think we put out a lot of content on LinkedIn as well. If you look at objective investment banking in LinkedIn, great content there. The team members that we have, we're just so blessed. They've got a ton of wisdom and they really are open to sharing it. Part of our cultural norm. So great place for them to go.
Okay. Well, thank you, Trevor. Appreciate your being on.
Yeah. Thanks, John. Enjoyed this. Take care.
Okay. Great. That was good. I'll get you I think I can probably email. Well, I'll set up a Dropbox or something and share the
Okay.
audio and the video.
Awesome. I'll share it with our marketing team. They do a regulatory search. I'm pretty good at not saying anything illegal.
Yeah, I don't think
and
you did.
and then they'll give you the green light.
Yeah, I will. I post the audio on Mondays and then the video that the same week, Friday. So next week I'll have them going live.
Awesome.
All right.
Awesome. And where is that background, John? Is that St. Bart's?
No, it's Antigua. So that's the story is for many, many years we've gone to Antigua. We take high school students and work in the schools in February. It's with my Rotary Club partners with the local school district, one of the local school districts, actually the best tech program in the state. And we take students and we set up Wi-Fi networks and donate. Like this last year, I think we distributed 1,300 laptops to the schools. They're
Wow.
used, I don't know about they're in good working order. Everything's been upgraded, etc. And we probably
That
set
is
up
really
Wi-Fi in like
cool.
15 facilities.
That is really cool. What a great story.
Yeah, thank you.
That's
So,
cool.
okay, I will get these to you.
Yeah, I enjoyed this. Thanks so much for your
Okay,
time.
all right.
Hey, you take care.
You
Bye.
too. Bye.